The focus on quality is characteristic of Japan. And even though some industries in Japan have faded away, like mass market memory production or flat panel production, that may have gone to Taiwan, Korea, China, but many of the core technologies and essential materials for those products are made by Japanese companies or under Japanese companies' patents.
Welcome to MoneyMaze curated podcasts. We created this spin-off channel to highlight a selection of innovative firms in the finance sector and beyond. If you visit www.moneymazepodcast.com, you can also sign up to our newsletter to keep up to date with episode releases and access a range of resources and materials relevant to each guest. If you enjoy this episode, please follow this channel and leave a review. Thank you for listening. In 1989, Japan represented 43% of the world's stock markets. The 8 largest banks in the world were Japanese. Business Week's Global 1000 list of the largest companies showed that 7 of the 10 corporations were Japanese, led by NTT. Yet by 1999, 10 years on, not a single Japanese company made it into the top 10. It was an epic bubble, and it was an even more epic bust. And 34 years after that peak, Japan is still the world's 3rd largest economy. It's the world's largest creditor nation, has the most undervalued currency versus purchasing power of any of the majors, and its equity market is still the 2nd largest in the world, and yet to exceed its previous peak of 1989, but closing in. But it has the highest debt to GDP of any of the G7 countries. What an intriguing mixture. And today, at circa 6% of the world index, it's beginning to perform better with a tailwind of constructive reforms. And institutional interest is stirring, would be the way I would describe it. Here today, we have 2 very seasoned gentlemen. Peter Tomaku, Kyou wa okane no mero no kono gensen ba iyokozo.
Yoroshiku onegaishimasu.
Yoroshiku onegaishimasu.
Peter Tasker and Mark Pearson, founders of Arcus Investment, welcome to this curated edition of the MoneyMaze podcast. If I were to paraphrase Mark Twain, reports of the death of active management have been vastly over-exaggerated because you at Arcus have demonstrated that long-term returns are possible in terms of producing an active and proven alpha. And I hope today we can develop an understanding of the Japanese investment and political and economic climate. But let's talk to you both, first of all. Peter, of life's coincidences, it turns out you were a few years ahead of me at school, although this is actually the first time we've met face-to-face. And you both have been in the Japanese business since the 1980s. Peter, you are a recognized and respected commentator on Japan. Your publications have regularly appeared in the FT and the Wall Street Journal. You're fluent in Japanese. And you were, which must make you very unusual, for 5 consecutive years rated the #1 strategist by the Nikkei. And Mark, you're also a fluent Japanese speaker. I know you graduated from Emmanuel College with an MA in economics. You actually trained as an accountant at Coopers & Lybrand, which is never talked about these days, is it? Because I'm not sure to whom it belongs. You were a Japanese portfolio manager at Kleinwort Benson and Long Short. Not many people have done that. I just want to ask you, just to set the scene, what drew you each to Japan?
Well, for me, in my case, there was a push factor and a pull factor. At the time, the UK economy was in a terrible state and there were no jobs. So that was the push factor. I wanted to go overseas. We were starting to see Japanese products in our homes, on billboards, yet we knew nothing about Japan. And I did have the opportunity to go to Japan, and I would try to learn some Japanese and see what was going on there. I thought that it would be a short-term secondment, and after that I would carry on doing something in the UK. But that never happened, and I never got recalled. So many decades later, here I am.
Mark.
Love took me to Japan. In my final year at Cambridge, I met a Japanese girl, fell in love, and went to visit her in Japan with her family in 1981. We married 2-3 years later, and we started a family. And as a result of that, I looked for a way to take my career to Japan so that I would actually be able to live there and we could raise our family there, to know both countries and both cultures. And through some very fortuitous encounters, I was able to join Kleinwood Benson, and I worked with Peter in his research department in Tokyo in the 1980s.
You established Arcus in 1998. You're celebrating 25 years. Just summarize. Who are you? Where are you? How many are you?
We established ourselves in London 25 years ago. We established a Tokyo office in 2004. And then we've established a Kuala Lumpur office 3 years ago. So we run out of these 3 locations. We started as a Japan equity specialist, and we remain a Japan equity specialist today. We have teams of analysts and fund managers in the 3 locations. So we have 3 researchers in Tokyo. We have a team of 4 investment people in London and 2 in Kuala Lumpur. We run in Japan broadly 3 strategies.
Total assets circa 1.7 billion?
We're about 2 now.
About 2 billion. Okay. And if I was to ask you each in a sentence to say what you think Arcus's strength is, Peter?
Well, I think our strength is basically being very, very true to our value credo. I would also say that we are a kind of bicultural outfit. I've been in Japan the entire time. So Mark also, as you mentioned, is a Japanese speaker, and we have many Japanese people in our company. So it's a kind of bicultural outfit.
That might be the longest sentence that I've heard.
I can give you more. I can give you more if you want it.
Mark, over to you.
We've been told that we are relatively rigorous by people who have seen other firms. So I think consistency is important, and related to that, perseverance. We have persevered over 25 years, which has not been easy. But I think a couple of other things, if I may add another sentence.
Of course.
And one is, being a value investor, I think, is quite a miserable profession. The companies that have been discarded, overlooked, disdained by other investors, and that's why they're so cheap. So you have to look at companies which are struggling, have problems. So I think there's an element of optimism to go with the perseverance and trust them that they will be able to resolve these problems. Of course, we do that after talking with them, getting to know the companies, getting to know the managers, and having to make a judgment on whether that is going to be realized.
2 things struck me. One, which I guess is now broadly known, correct me if I'm wrong, but half of TOPIX trades below book value. And the other very intriguing observation was that circa 40% of the Japanese stock market lacks coverage from a single broker. How do you go about the discovery process of names that you want to do work on?
We do a lot of data processing, a lot of screening and multi-factor modeling. So that's one way in which we identify opportunities. So my day starts off with repricing the whole Japanese market, almost 4,000 companies, and every day is a new day and looking for new opportunities. And starting with the quantitative work, then moving on to look at the individual companies, both myself and our colleagues in London and Tokyo and Kuala Lumpur, getting into the nitty-gritty, trying to understand these businesses. So that's the broad brush of how we approach investment in Japan.
So you've written, without significant misevaluation, we will not invest. So I would like just you to walk me through the screening, throws up ideas. What are the next steps?
Our portfolios are always significantly cheaper than the overall market. So, for example, currently TOPIX PE is probably in the 13 to 15 times range. Price to book is probably 1.3, 1.4. Well, our portfolio might be 9 times, 8 times, or even 7 times earnings and 0.6, 0.7 on price to book. So the whole portfolio is massively discounted to the overall market. And in order for a new company or a new stock to get into our portfolio, they have to compete against the existing portfolio. So they have to be even cheaper in a way. So our process is a process of continually taking profits in the companies that have done well, which have made significant appreciation, and recycling those funds into much cheaper stocks. And that's our bread and butter, day after day, week after week, year after year. It goes back to a Buffett type of concept. In owning a stock, you own a little piece of a business. And when we look through to the little pieces of the business and aggregate it, we accumulate considerable fundamental value over time.
Can I just say, having worked with Mark for many, many years, there's a psychological element as well. People like to be in the herd. They like to be, it's safer to do what everybody else is doing. Furthermore, if it's a great company, even if something goes wrong, you can still say, well, it's a fabulous company. So the growth investors can wax lyrical about the kind of stocks that they like. And people can be overpowered. Wow, look at that company. It's fantastic. Well, that's not what we do. And we are not afraid to be the lone wolf just doing our stuff and making our judgments. And it's a lonely place. And people say, why do you like that company? Nobody else likes it.
So I'm fascinated because we know that even though you're both fluent Japanese speakers and lived in the country, you are foreigners. What do you hope to achieve when you go to these companies?
If you go back many decades, Japanese companies did not welcome investors showing up and gave them but sometimes give them the runaround, or would sometimes say, no, we don't want to talk to you. Why should we talk to you? That's totally changed now. And the companies, with a few exceptions, are very happy to talk to investors and are concerned about what we think and what investors think.
Understood. So, Mark.
First of all, I wouldn't like to differentiate Japanese companies too much from any company anywhere in the world. I mean, ultimately, they're broadly aiming for the same thing. They're aiming to grow their business. They're aiming to be profitable. They're aiming to make money. It does help to speak Japanese. It helps to know Japan. I think one of the things that both Peter and I have done over the decades is to know many aspects of Japan. You know, Peter has written novels and written books about Japan and is very knowledgeable about certain aspects of Japanese culture, like film and literature. And in my case, I've got into things like Japanese chess playing, Japanese music playing. I learned the shakuhachi, Japanese pottery, and Japanese photography. So we both have had a considerable and broad exposure to many aspects of Japanese culture. And I think that helps one to relate to Japanese people in their companies, because we're not really coming in from outside. I mean, we feel very much at home in Japan.
Understood. Now, one of the observations that's been made, which is intriguing, is that Japanese corporations are, if not preoccupied, one of their highest priorities is the quality of the output. So they would prefer to make the world's best air conditioning system, if you're Daikin, than perhaps profit maximization.
If we look at the sustainability of a company, it's quite interesting that most of the companies that have the longest history in the world are Japanese. And I would say that in the 80s and 90s, many of the companies did not pay enough attention to profitability. And as a result of that, they went for market share. And that left them high and dry when demand fell in the 1990s. So I think they are much more profit conscious now than was the case when the economy was growing like topsy. But nonetheless, there is this element of sustainability, which is, I think, a longer term approach, which actually makes sense.
The focus on quality is characteristic of Japan. Japanese people like to do things well and carefully, and that's also reflected in the society. Japan doesn't have many of the social problems of some of the Western countries. Despite this long period, as you described it, a long bust, a long economic stagnation and deflation, Japanese society on the whole remained a remarkably pleasant, peaceful place with a good quality of life. I've shown you how cheap real estate is in real terms. It's affordable in Japan. I mean, it's not really affordable in many other places around the world. And I think this attention to detail and focus on quality is a core strength. And even though some industries in Japan have faded away, like mass market memory production or flat panel production, that may have gone to Taiwan, Korea, China, but many of the core technologies and essential materials for those products are made by Japanese companies or under Japanese companies' patents. For a long time, this dash for market share was impairing margins, excess investment in the 80s. But part of the massive adjustment which has taken place in the last 30 years is to focus on efficiency, a huge repayment of corporate debt. So the corporate sector is now in net cash, and an increased focus on profitability. So profit has really improved most markedly since about 2010, 2012, and has steadily improved both on the operating level, but also on the non-operating level. I think people tend to overlook how much of an improvement Japanese companies have made on the non-operating level, which is very significant. And also, I think, even though the improvement has been made, we don't think it's reached the end. I think margins are just now reaching respectable levels, and we're not at the high level which would suggest that they may be unsustainable, but rather the improvements which are underway can be extended.
As we think about the bottom up, the opportunities that are being presented, you have had this terrific track record over a long time. You've owned names that have been repriced importantly, such as Sony Hitachi, and we have the prospect of a stronger yen, but we also have this bifurcation in terms of half of TOPIX trading below book value. As I again read your materials, and you've referred already to the real estate landscape and the repricing that's happened there, I was struck by one of your companies that you talk about, which is Mitsubishi Real Estate, and I'm old enough and been in this business long enough to have known that I owned it at various points in the cycle, and now down at half book value, I believe it's featuring again. Can you just maybe give us a flavor of why now?
We very much like to invest in companies where the skew of potential outcomes is in our favor. So where the downside risk is very low and the upside potential is very high. So let's look at Mitsubishi Estate in recent years. The price to book, the price you pay for the company, had fallen to 40 or 50 cents on the dollar value of their equity, which is basically their portfolio. And yet, when we look at the record of the company, it has had a very impressive and very consistent and steady accumulation of both that underlying asset value, also their profitability. So we felt, first of all, it was trading at unprecedentedly low valuations, extremely cheap in absolute terms. And then when we look back, if we look back to the mid-2000s, 2004, 2005 was the last time when Japan had a market which was being pushed up by reflationary expectations. And the real estate companies performed very well. And we only have to go back a decade to see Mitsubishi Estate and its peers like Mitsui or Sumitomo Realty trading at 1.5 to 2 times their asset value. So we felt that this was a situation where the downside risk is extremely low, is almost inconceivable for Japan's highest quality real estate company to trade much cheaper than 40 or 50 cents on the dollar, with a very good track record, and good prospects. Of course, the reason it was cheap, everyone was worried about rising vacancy rates and global real estate worries during the pandemic. And people had underappreciated the strength and resilience of these Japanese companies, where vacancies rose a bit, but only to about 5% or so, and have started to improve. So people have associated these very high quality Japanese companies with some rather low quality global real estate companies.
And as this dispersion in valuation in terms of market capitalization has happened, has your portfolio gravitated to the median market capitalization being lower than it was 2 or 3 years ago?
No, because as I mentioned earlier, we continually recycle the portfolio. So as the companies that we invest in perform, they get to a little bit higher valuation. They tend towards a fair value, but we tend to sell it before it gets to fair value. We're often early to sell, but also early to invest. So if we buy a company on half book value and it goes up to 1 times book value, we've doubled our money, but we'll take that 1 and reinvest it into another company at half book value, and essentially we've doubled the fundamental underlying value in our holding. So our process keeps us continually on the move, like a shark, if you like. The shark can never stop, but we have to keep moving and keep on recycling our portfolio into ever better valuation.
Given what you've told me, I would be inclined to think it must be more difficult to find the shorts. How do you explore the short side, and where are you intrigued?
We have real companies on both sides, longs and shorts. In Japan, one of the things that we monitor very closely as the months go by is the dispersion of valuations in the market. So what is the distance between the very expensive stocks and the very cheap stocks? And what we found is that during the decade up to 2020, this dispersion went to exceptionally high levels. So it meant that the expensive stocks, which is where we find our shorts, were very expensive compared to the longs, which were at historically low valuations. So the dispersion was historically at an extremely high level. So we've started to see that narrow in the last 3 years. So our returns have been boosted in the last few years by this narrowing of the dispersions. But where the dispersion is now, it's still roughly where it was during 2019, which was still high, having expanded for the previous decade.
Well, that's great and very helpful. Now that allows us to move to Japan, but to reflect a little bit on this extraordinary evolution. Back in 1987, you wrote a piece on Inside Japan, and I wondered, for those listening, and it would be fair to say many will not have the length of experience of dealing with Japan as the two of you, how different is Japan today?
In many ways, it is significantly different. And of course, one of the elements has been that Japan has been, as an economy, has been through the ringer. We saw the decline in house prices and land prices falling basically from peak 80%. And the stock market likewise. Not only was it a very deep decline in the stock market, but it was very long. And that, of course, created a aversion to risk assets, and particularly equities. It changed people, the culture. Many, many things have changed. And yet, Japan is still identically Japanese in a way that is different from the West.
And I'm going to add here, because Niall Ferguson, the economic historian who's been a guest on the Moneymates podcast, made the comment the other day that Japan has never mattered more geopolitically, formidable naval and military power, important US alliances, and would be crucial in any conflict over Taiwan. Let's talk about the economy. And although I, too, have been an investor in Japan since I started in the business a very long time ago, I think one of the things that many investors struggle with is this conundrum that Japan is the largest creditor nation in the world, and yet it has the highest debt to GDP. And how do you, maybe not reconcile, but how do you weigh up those extremely unusual observations?
That is an important point, and it's a tricky one, because a lot of people have said, really from the 90s onwards, that this bond market must blow up And that's why they call it the Widowmaker, because every time somebody tried to put that trade on, they got blasted. The reality is that the government, the Japanese government, has a large debt which it owes to the Japanese private sector. So it's basically in the closed circuit of the Japanese economy. As you said, Japan is the largest creditor nation in the world and has been running current account surpluses basically since the early 80s. It's a very sound economy.
And we're going to talk about the Japanese savers and some of the allocations, which are startling by Western standards. But let's just talk about interest rates. Japan has done many things that are unusual. It was the first to have the ZIRP, zero interest rate policy, but it's also been the last. And now we've got stirrings at the Bank of Japan that we might see some, I won't call it rate normalization, but rates moving off the floor, particularly given that inflation has been coming in sort of 3%. How do we think about the central bank's likely path from here?
I think the story is that the Japanese authorities, including the central bank, but also the establishment as a whole, wants to see Japan get out of deflation definitively and never get back. And if that's the case, they need to see a kind of cycle of higher wages leading to higher prices. In a Japanese context, that would mean something like 2%, which is their target. And if they were to get to see that, then they would move and probably raise rates a little. But having said that, I don't see a large rate rise on the menu at all, because they have done that prematurely in previous occasions this century, and it turned it out to be a fiasco. So this time they want to be absolutely sure. The result of that, of course, has been that the yen has been unusually weak, given that the inflation levels in Japan have been consistently much lower than anywhere else.
Mark, I know you want to make an observation.
Well, regarding interest rates, whilst I believe that we're in an era of rising rates and rising inflation, it doesn't go in a straight line. I think we're going to have a number of ebb and flow of the markets on the way to steadily higher rates.
But, as I said at the outset, is the yen has become the cheapest currency, essentially, of the Western world, which I guess begs the question, how do the Japanese feel about that?
Well, it depends which Japanese you're talking to. Most of my career has been in a context of an overbearingly strong yen. And that is why so many people want to go and have a holiday in Japan, because previously it was incredibly expensive. Now it's really dirt cheap. So that is one way of looking at it. But of course, in reality, what we're seeing here is a big increase in competitiveness for Japanese companies, and probably over time, onshoring of production back to Japan if the yen remains at this level, and more import substitution as Japanese makers come in and can produce stuff at a much cheaper level.
For those Money Maze podcast listeners who didn't hear the Scott Bessent interview that we did, who was George Soros' CIO, he goes into some detail, having a very bullish view on the yen, of his signposts and his positioning. Mark?
Just to illustrate how cheap the yen has got, I could mention about 7 or 8 years ago, I bought a small house in Japan to stay while I was there. And I paid 45 million yen for a house which is within walking distance of our office in Arcus's office in Tokyo, in Shibuya. So about 30, 40 minutes walk into the office, 45 million yen. It's about £250,000 now. My son, who lives in Japan, bought his main house for a similar price. He had previously lived in London and struggled just to live on a regular wage in London. Recently, he bought an old house in a pottery village just north of Tokyo, 2.5 million yen. So £13,000 for a house with land. That's just a stark illustration of how cheap some things in Japan are now, from having been a ridiculously highly priced land market when Peter and I lived and worked there in the 80s.
I want to talk about these structural and regulatory changes. And one of those is within the household allocations. And if my data is right, we have over half of Japan households' wealth in cash. How does the domestic community, and I'm going to ask the question first, retail, and then we'll think about institutional, think about equities?
Well, what you've got, I think, is something similar to the experience that my parents had in the 1970s in the UK in regard to gilt-edged bonds, which is don't ever touch those things again in your life. And that, of course, proved to be wrong because there was a tremendous disinflation was tremendously good for gilts. It's the trauma, the financial trauma of seeing people impoverished. And that generation probably will never go back into equities. But now we are, more than 30 years into that cycle, a new cycle. Domestic investors are much more relaxed with the equity market. When you've got deflation, you can't have too much cash. And Japan was in deflation, in and out, basically from the mid-1990s until the Abe era, which is 2013 onwards. So the take-home from that for companies and for individual investors was keep your cash. And it became a big thing for people to actually own safes. They would have a safe in their house. So that was the kind of risk-averse mentality that people had. At least with the cash, you get it back.
Yep.
With the equities, you might not.
Right. And that is in contrast to the rest of the world that is learning fast that cash is not a wise thing to have in a world where central banks have been creating lots more of it. Institutionally, how are they thinking about the risk-reward of equities?
I think it is starting to become acceptable. And one of the big changes here that we've had was the creation under Abe of the GPIF, which is the government pension fund. And he made it into a much more professional outfit. And it was always huge. But now they've got a asset allocation, which is 1/4 Japanese equities, 1/4 overseas equities, 1/4 Japanese bonds, and 1/4 overseas bonds. They have a contrarian bias. If equities go down, they buy more. If they go up, they will sell a bit.
Right.
So that has been, I think, a big inspiration for the equity market and is actually pro-equity now.
Right. So we've got these government-instituted reforms to develop an equity culture. You've got an asset management industry the government wants to develop. But you've had this Tokyo Stock Exchange, I'm going to call it, or it's been called the Name and Shame campaign. Could you just explain what that is doing?
Yes. Back in January of last year, a year ago today, close to it anyway, the TSE announced the results of a paper resulting from a committee that they had, in which they reported that they would ask companies who had a persistently low return on equity, and in particular, a low price-to-book ratio, to account for the reasons for why that price-to-book ratio was very low, and more importantly, what steps the companies would take to remedy the situation. And all of this was really in the name of improving capital efficiency. And it has had an immediate effect on the corporate sentiment. However, the way I see it is that it is the latest in a multi-decade process of similar measures, which began with the legalization of share buybacks in the 1990s, followed by adjustments and developments of the corporate code, changes to the merger regulations, and so on. So there has been a continual series of measures over 2 to 3 decades, which is pushing the Japanese companies towards greater efficiency, greater profitability, and greater capital efficiency, which has resulted in these various changes. So more dividends paid by Japanese companies, more share buybacks, more LBOs, MBOs, more takeovers, and steps that companies are taking to improve their share price valuation.
It would be remiss for me not to bring up another very successful investor, Warren Buffett, who has been dipping his toe in Japan now for a little while. You have some similarities, I think, in terms of your patience and your search for value and moats, etc. Have you found yourselves fishing in the same pond?
Well, to an extent. Buffett's imprimatur for Japan, he actually went out of his way, he didn't have to do it, to be very complimentary about Japan as an investment destination. Last spring, his preferred holding period is forever, whereas we do turn over. But I think he came and bought the trading house stocks. He was very clear, and he said he bought them because he felt that the dividends and buybacks that they were rewarding shareholders with were a very strong point. And he also felt that the companies had a good future.
So, Mark, would you add anything to that?
We've long invested in the Japanese trading companies because for many years they did trade extremely cheaply, some of the cheapest companies in the market. And opportunistically, at times we were holding Mitsubishi, Mitsui, or at other times we had a greater exposure to Sumitomo or Itochu. However, the performance of the trading companies in the last couple of years has been quite phenomenal. And on some measures, they're not trading very cheaply within the market. And in some measures, they're trading relatively expensively relative to their history. So I think there are some good things to be said, but nowadays we don't find them quite so compelling.
Peter and Mark, I'm going to try and summarize our conversation for potential investors and others listening. And that Japan is not the Japan of 25 years ago. It has a landscape where the corporate culture has shifted, where investor appetite is also changing, where there are structural tailwinds that were absent previously, both governmental and regulatory, where there is the potential for a lot of capital repatriation, even if rates only move to 0.5% from their zero. And with that produces a potentially stronger yen and a skew to the portfolio in terms of what you may want to own. And I suppose we've always thought of Germany and Japan as the sort of the, should we say, the countries who epitomize excellence. And so I was very struck by this. I'm just going to quote it. It came from one piece of research that I was reading. It says, such as this change in corporate culture and a new spirit of dynamism, which contrasts from Japan with Germany. In Germany, 72% of all German trains are at least 30 minutes late, whilst cumulatively the daily delay of all Japanese trains is 3 minutes and 17 seconds. With that, Mark, Peter, it's been a great pleasure talking to you both today.
Thank you very much.
All content on the Money Maze podcast is for your general information and use only, and is not intended to address your particular requirements. In particular, the content does not constitute any form of advice, recommendation, representation, endorsement, or arrangement, and is not intended to be relied upon by users in making any specific investment or other decisions. Guests and presenters may have positions in any of the investments discussed.